Hello everyone, welcome to Property Ponderings. My name's Craig Nicol from Nicol Buyer Advisory in Melbourne, Australia, where we help people buy and renovate their dream properties. I'm bringing to you over 15 years of property experience as an agency owner, property investor, renovator, town planner, salesperson, auctioneer and buyer's agent, and I want you to make better property decisions and build the future that you're chasing. In today's episode, we're talking about a strategy that often goes against the grain but can yield significant returns, and that is counter-cyclical investing in property. What is counter-cyclical investing? Counter-cyclical investing refers to making property purchases during periods of market downturns, or when property prices are falling or stagnant, as opposed to buying during a boom. The idea is that you can secure better deals, lower prices, and position yourself for significant capital growth when the market recovers. Essentially, you're buying when others are selling and selling when others are buying, which is a lot harder than you might think. This strategy requires confidence in the long-term property market and a good understanding of market cycles. Many investors get caught up in the market hype during peak periods and peak booms, which often means paying inflated prices. Counter-cyclical investors do the opposite. They patiently wait for the opportunities when the market sentiment is low, when others aren't looking to buy, and the prices are a lot more reasonable. Now, the benefits of counter-cyclical investing. The first one is that there's better value for money. During downturns, there's typically less competition from buyers, which means you're more likely to negotiate a better deal. Sellers may be more motivated, especially if they need to sell quickly, and you could end up securing a property below its intrinsic value. By avoiding the frenzy of buying in a hot market, you're positioned to buy when prices are lower, which could mean bigger capital gains down the track. I know in the current Melbourne market where things are quite flat, that there are a lot of opportunities for our clients out there, and I'm encouraging other people to get out there and get amongst it as well, as although there are limited properties available as people are trying to hold on for a better market, those ones that are on the market for whatever reason are providing wonderful opportunities. Instead of auctions having 3, 4, 5 potential competitive bidders, you're only finding that there's 0 or there's 1, maybe 2 on really good quality investment grade long-term properties that you know are currently sitting at well below what you know they can sell for in a slightly better market. So you've got some quick gains if the market does turn around. But as I've mentioned earlier, there is some risk with that, which we'll go into a bit later. Now, the second benefit is that when property prices soften, rental yields often increase. This happens because rents remain steady, but property values drop, meaning the rental income as a percentage of the property's value improves. For investors looking for income, this is a great time to buy. And in Melbourne, as an example as well, because obviously I'm working in Melbourne, Australia, the market being so flat, combined with the fact that rental prices and the cost for tenants has gone up significantly over the last few years, it's meant that yields have improved dramatically. But it's good to remember that the yields in Melbourne especially has historically been the worst across the whole country. So it's sort of getting to a point where they're slightly better, but they're certainly not as attractive as many other states around Australia. The third benefit is long-term growth potential. So counter-cyclical investing requires patience and a long-term perspective. While the market may be down when you buy, if you've chosen a property with good fundamentals, such as being in a growth area or near upcoming infrastructure projects, the market will likely recover and you'll benefit from significant capital growth. The good thing to think about here as well is that with that longer-term perspective, that the timing of our decision here is difficult. So that's why that long-term perspective is really important, because when you go into a counter-cyclical buy, and using now as an example, we don't know exactly when Melbourne will rise in price and things will get competitive again. So you sort of have to be confident that it will grow, but you also have to be able to know that it's not just going to happen straight away. It could, but it's most likely not going to happen straight away. So you need to be able to ride out that market, which could go even lower as well, because it's very difficult to pick the bottom of markets. That's not our feelings with the current Melbourne market. We feel like it's dipped to its bottom and it will rise, but you never know, and that could continue, especially with the current unknown with interest rate environment, and also changing government policy and other global factors that are playing a role in potential price movements as well, for that example. Now, considering those three benefits, we need to think about the risks as well. So while counter-cyclical investing offers great potential, it isn't without risks. So the first risk, which I've just alluded to, is timing the market. It's notoriously difficult to time the market perfectly. If you buy too early in the downturn, you may see prices fall further before they recover. The key is to focus on the long-term fundamentals rather than trying to pick the absolute bottom of the market. The second thing that you need to worry about is access to finance. During a downturn, lenders can be much more conservative. Interest rates may rise like they have in Australia recently, or lending criteria might tighten, making it harder to secure finance. So it's important to ensure you have pre-approval or strong financial backing before diving into the counter-cyclical opportunities. And I think an interesting point here is that over the years, you see people that are trying to chase a down market or hoping that the market goes into a bust environment where no one wants to buy, property prices are dipping, because they think that it will be much easier then to buy properties and they'll get a massive gain and everything will work out better for them. But the reality is the access to finance normally becomes a whole lot more difficult. And so you're suddenly hoping for that 20% fall, but then the 20% fall in prices that has occurred has meant that when you go to a lender, they'll probably lend you 20% less, or there is some sort of downfall in how much you can borrow. So you suddenly can't buy that $1 million property anymore that you thought you were going to buy with your $800,000 budget. Now your $800,000 budget is at, say, $700,000, and you can't buy the property that's dropped in value down to $800,000. So I hope that example's made sense. But in summary, that reality that if a market falls, the access to finance is harder. So these sorts of markets where we're doing counter-cyclical investing, it tends to favour those that have more cash reserves and more availability to banking finance, because then when the market does fall, their pockets are full and they're able to take advantage of that market. Whereas for the majority of people, when the market falls, it's much more difficult to get finance, and then you're in a difficult position. You actually have to spend less as well, and so you can't get the property that you want anyway. Now, the final risk or concern that you need to be worried about is potential vacancy risks. If the property market is weak due to broader economic issues such as high unemployment, there might be higher vacancy rates or downward pressure on the rents. Be prepared for the possibility of slower leasing periods or lower than expected rental income. Now, I've got 3 key strategies when you're thinking about doing counter-cyclical investing. So firstly, let's focus on location. Even in a downturn, location is king. Look for areas with strong long-term growth drivers, such as great schooling, public transport links, a lot of employment hubs, and infrastructure projects. So money going into these areas, and hopefully more money from buyers coming in to follow that. Suburbs that have stagnated in the short term but have underlying demand will tend to bounce back strongly when the market improves, and we continually see this through the historical figures of great suburbs in Melbourne and Australia. The second strategy is to be patient and do your research. Counter-cyclical investing requires discipline. Don't rush into a deal just because prices are falling. Do thorough research on local market trends and ensure the property meets your criteria for both income and growth potential. Sites like CoreLogic and realestate.com.au offer data on suburb performance, historical price growth, and rental yields to guide your decision. Now, it's really easy to get FOMO when the market's dipping. Maybe your friend has just purchased and he's bought an absolute bargain. Don't rush in. Make sure to do your research and ensure that the property that you're looking at will meet the criteria of what you're actually wanting in the long term, because there's nothing worse than rushing into a market that's really cold and then buying something that's a dud and then it not actually bouncing when the rest of the market comes back. Now, the third strategy for counter-cyclical investing is maintaining financial flexibility. Ensure you have financial reserves to weather any potential storms, such as interest rate increases or periods of vacancy. Being financially flexible allows you to hold onto your investment until the market recovers, rather than being forced to sell during tough times. And that's particularly risky if the market that you are jumping into because you think it's maybe the bottom and you think you're trying to complete counter-cyclical investing, then the market goes even lower and lower, and then you just don't know when it's going to rise. So you have to be really careful of that when you're trying to complete this sort of strategy. So in summary, I think counter-cyclical investing is a strategy that takes courage and patience, but when done right, it can lead to significant financial rewards. I know that through COVID, there was an early stage there where prices and interest in properties really dove just as the pandemic was occurring, and I saw a huge opportunity to get in at that time, and for me it worked out really well, and also for some other clients of mine to buy in that particular period, and they did see a jump quite quickly because the sentiment had changed and it had gone extremely negative, but then it quickly went to positive as interest rates were cut and people saw that house prices were rising and rising very fast. And I think that that's particularly relevant as well as we move forward now, looking into that Melbourne market. We can see that sentiment is really poor, and it has been for a few years in general. And so there is an opportunity, but when exactly will the market in Melbourne get better, we don't know. But I think that there are plenty of opportunities around right now, and remember not to take that opportunity to buy the wrong property. There's still a very small percentage of properties that are ideal for this sort of investing or investing in general, or maybe buying a home. So you have to be really careful, but I think that opportunity is certainly presenting itself at the moment. And so with counter-cyclical investing, by buying when others are hesitant and focusing on long-term fundamentals, you can secure better deals, potentially higher yields, and substantial capital growth as the market rebounds. An important note though is that my advice for buying a property, because this strategy is very much about timing, it appears to be about timing the market and thinking that you're at the bottom and you're trying to buy when properties are at the cheapest before they rise again, but that's not necessarily what it's about. You're trying to take advantage of poor sentiment in the market at a point in time, but that's only if you have either the financial capacity to do that, to be able to take the leap whenever you see these opportunities arise, which tends to be people more advanced in life who have built up more equity. But normally for buyers, the counter-cyclical investing in properties is more about the opportunity that you get when your time has come and you're in a position to buy a property, and it just happens to be at a time where the market's quite flat. You don't want to sit on your hands. You want to take advantage of the situation to buy the best possible property you can at the best price to secure your financial future. Too many people sit on their hands, and then in this sort of environment they can see the sentiment's quite bad and they delay their plans to buy, or they're concerned about what's coming up. And I understand everyone has their own risk appetite and belief in the property market, but for me, I think that the confidence that the historical data shows that the property market does come back in bigger cities such as Melbourne and those that have really strong growth fundamentals. I think that confidence is really strong to be able to take advantage of this sort of situation in any cycle. And it doesn't have to be every few years, or there's no specific timing of when this can happen. It's just at any point in time that can occur, as we saw, say, with COVID, my example before, where you have a bit of an effect for a small amount of time where you either jump in or you wait. And I think identifying when you have that change in sentiment rapidly that may be an overreaction, then there's the opportunity. And then on the flip side of things, if the market is moving rapidly upwards, then you may choose to sit on your hands at that point in time, But again, you have to be careful that if you're not necessarily looking to strategically invest and build a portfolio for the long term, that you don't simply wait till the property market is at a flat part, because you just don't know when that flat part's coming either. So this strategy sometimes involves a little bit of luck and timing. If you are in the market when you're looking to buy a new property and the market's quite flat, or it's becoming quite flat, then you have an opportunity. But if you're in the market, you need to buy a family home and the market's rising quite rapidly, you have to make a decision, and you can't necessarily just wait for the market to be flat to complete, say, this type of strategy. I think that that's the component of luck with timing. Like, you just don't know what's going to happen. So I don't want to say that just because you're a counter-cyclical investor that you're only investing when things are flat. I think that at the end of the day, you need to keep pushing forward with your property portfolio. And if you buy a property when the market's pretty neutral, or if it is quite strong, you can do that as well. But you just have to make sure that you know what you're doing, and that if you do want to counter-cyclical, if you do want to invest counter-cyclically, that you are maybe going in a bit harder when things are flat, and then when things are softer, that you might just go a little bit softer as well with the amount of money that you're putting into the market to try and manage your risk. And I know a lot of people do this with shares, and it's just a way of dollar cost averaging your money that you're putting in there. So look, that's a bit of a ramble at the end, but I hope that just touches on a few other points where people might be wondering how counter-cyclical investing fits in with the overall plan and investments moving forward. I think you have to keep an even head about it. If the timing's off and you can't invest counter-cyclically because the market's been going up for 15 years, you don't wait 15 years. You have to get in when you're ready to get in, but you also have to take advantage of that counter-cyclical investing opportunity. And I think most people only do one way. They wait till the market sentiment's good, so they have the confidence to get in. And when the market dips, they're worried that it's going to keep dipping for ages and drop and drop and drop. So they wait until the market again is in a better, more positive light, and then the market starts rising again. So you're saying that you're missing an opportunity because you're following along with the market sentiment. So that's something for people to think about if you're out there looking to buy. But that ends another episode of Property Ponderings. I hope this has given you a few insights into counter-cyclical investing and how you can use that to your advantage in property markets. If you do want to discuss anything further from this podcast, feel free to contact me on 0400 122 081, or send me an email at craig@nickelbuyeradvisory.com.au. Thank you. Information provided in this podcast is for general information purposes only and does not constitute financial, legal or professional advice. While we aim to provide accurate and up-to-date information, every property transaction and investment is unique and should seek the advice of a qualified professional before making any financial decisions. The opinions expressed in this podcast are our own and are not a substitute for tailored advice from a financial advisor or a real estate professional. We encourage you to consult with a qualified expert who can address your specific needs and circumstances.